partnership.
I appreciate the difference in Jay's theory and yours, Ralph, and it is interesting that there is no question that when you deal with a strategic partner, that it can involve a sort of premature or de facto sale of the company. It can also, in certain instances, create an artificial ceiling on the ultimate valuation of the company. But Ralph's point, I think, is equally important, that if you have interests that are aligned and you have that very honest and open discussion up front, and you have appropriate provisions in the strategic alliance that goes along with the investment, that it can be an incredibly valuable relationship. A perfect example is a transaction we did just this summer where we had a management buyout from a very large research organization, and our client did a strategic partnership with a gigantic electronics company at the same time that they did a venture investment with a financial investor. And it was interesting to see some of the differences between the financial investors' hot points, if you will, and the strategic investors. And I think it is very important, if you're going to have that you work hard to make sure that you have complementary relationships and not ones that are going to end up potentially adversarial. I know we only have about 7 or 8 minutes left, so let me ask one more question and then turn it over to the audience. One of the questions we always get as counsel to early stage companies is, what am I worth? What should I be looking at in terms of evaluation? I'm trying to raise $1 million or $1.5 million. What do I have to give up in terms of the ownership of the company? And how do you address that with early stage entrepreneurs when we know that valuation is such a hard question, and it's far more of an art than a science?
So I have a simple formula for figuring out valuation. If you have 0 term sheets, that's your valuation. If you have 1 term sheet, that's your valuation. It only gets interesting when you have 2 or more term sheets. At the early stage, it's an arbitrary number, and it's driven primarily by competition. So we invest in the, let's say, $4 to $6 million pre-money valuation. But if there's a hot company that we really like, will we go above that? We have. If there's a company where there's maybe not a lot of other VCs around the table, and we believe that there's a lot of risk in the company, have we gone lower before? Yes. But unfortunately, there is no determiner at the early stage other than sort of general expectations of what a seed investor or Series A or B or what have you might put on.
For us, we kind of look at it, a lot of our investments are companies that are selling something and that have a very clear business model. So what we try to do is, like, when we invest in a company, if they're, has a run rate of like $1 million, where that's what they expect to do in the next 12 months or what they've done in the past 12 months, we kind of do like anywhere from a 2.5 to 4x valuation based on their run rate. We try to be very fair on valuation because our goal is really to find, to get in on the deal at a fair value and at a value that makes sense, so that when you raise the next round of venture, your previous valuation doesn't come back to haunt you. A lot of it, when I did my startup way back in 2007 and I moved to Silicon Valley, I got term sheets for a $5 million valuation with a PowerPoint presentation. No technology, no engineers, just me in a room with my co-founder wearing t-shirts and jeans, and we got $5 million valuations. Those days are kind of gone nowadays. That's not going to happen. There was a reason why that happened back then, is because to build the technology you needed to build back then required millions of dollars. Nowadays, with all the infrastructure, AWS and Google Web Services and Azure, you can build a lot of things you can build in under 6 figures. So a lot of times these VCs come in saying, I want you to actually have a working prototype, or even more, I want you to have customers, users, I want to see metrics, growth, stickiness, and they will base valuation based on that right there. But I think the biggest determiner I've seen is, for us, is like, we look at what your revenue is and what the growth rate is. So if you're growing like weeds, we're willing to overpay for that. But if your revenue is decent, but you're not really growing, we might not even do a term sheet there.
So I have a portfolio view of a lot of this. The
we'll go with the market price, whatever the private investors in the transaction with us are. But that said, we're seeing through our fund of funds, pretty much on average on the IT side, the tech side, what Jay's saying, 2.5 to 4 times revenue. And that's really kind of common, I think, for this part of the country, or particularly in New Jersey. I think there's some hot deals in New York that people will pay up for. On the life science side, we see much bigger valuations, and on the clean tech side, we see much bigger valuations. The other thing I would say on the angel side, what we're seeing, convertible debt. So the angels really don't want to set the price on the transaction either. They're going in and they'll price with the next round.
Sure, I think those are great points. What I'd add to that is the following. I mean, so I've been now doing ventures for about 15, 16 years, and I would describe the position of a venture capitalist as someone focused on risk minimization. So, now again, I don't invest in consumer deals. I typically invest in industrial deals. But every point that you can get as an entrepreneur which reduces risk, from my perspective, is going to bump up your valuation. So if you have something that is beyond PowerPoint, it's actually a working prototype, that's great. If you've got intellectual property protection, that's also great. If you have some level of customer validation, the customer doesn't even need to be paying for it, but if you have a customer reference point, so I can call someone and talk to someone other than you, the entrepreneur, who can tell me about the technology, tell me how well it works, that's also great. These are all points which are going to add to the level of valuation because they're all factors that minimize risk. So I think it's always important, as when you're an entrepreneur, thinking about talking to a financier to figure out, well, how can you show and demonstrate that you minimize some level of risk, because that's going to help in the valuation question. Again, I'm not talking about consumer deals where lots of times things are driven by marketing. I'm talking about things where it's nuts and bolts. Does this technology work? Does it fit the function? And does it actually execute on a particular application?
Jay, you wanted to add something?
Yeah, there's an interesting point that he brings up over here, which is to minimize risk. There's a saying in engineering called the single point of failure. A lot of you probably heard of it, which is in a system, like in a machine or something, if one thing stops working, the entire system stops working. I have a term that I call single point of success, which is that when I work with my companies, I'm like, look, when you go for your next round of capital, minimize every single risk that the other VCs are going to see so that they can say, hey, you only got to do one thing really well. And if you do that, you're going to be a big business, and that's what I'm betting that risk on. So what I tell my companies is like, look, when you go for the next round, make sure your operations are perfect. You have a great, operational system. Your logistics are all set up. Your customer acquisition, you have a great CMO in place. You have a great CTO in place. And you can really say, our success is going to be determined by just one thing, which is us being able to build a better product like this than our competition. But everything else, we've nailed over here. And a lot of VCs will, get really excited when they see a company where they're like, hey, they just got to do one thing really well, and we're looking forward to that. So if you look at sometimes like a food company, they can be very scary investments for a VC because they have to do a lot of things well. They have to source the food well. They have to do the logistics well. They have to do the supply chain management extremely well. They have to do customer acquisition, which is more and more expensive online, really well. And then on top of that, they have to create a great, customer experience by making great food. So the more things you can take out of risk over there, the higher those companies will get its valuation. But that's why you see these companies having a hard time sometimes. These food companies nowadays having a hard time is because there's so many failure points that they have across the way.
This was extremely helpful. There are 4 takeaways for me. One, and Gil, I'm now going to use this with my own clients, the get real theory of valuation. Discipline, we expect you as entrepreneurs to be incredibly passionate and optimistic, but the market will dictate what the value is. And so I think having a dose of discipline and realism built into your expectations is extremely important. The other thing that I heard was really distinguishing between those companies that have observable performance metrics, whether it's revenue or positive cash flow or customer acquisition or market acceptance, etc., being in a very different place than an earlier stage company that Gil might be interested in. You know, Gil, you talked about your interest in investing even in pre-revenue companies. So I think that's very important. That goes back to where we opened all of this with do your homework. Know what the potential investor's expectations are, what they are interested in. One of the other things that I think is extremely interesting, and I'm not sure, I think it was you, Kathleen, that talked about this, is the declining capital intensity. And actually, I think, Jay, you alluded to it as well. There is a far lower capital requirement for entry into developing an entrepreneurial enterprise. And so that results in a lot more entrepreneurial activity, a lot more innovation, but I think it also results in a more efficient use of capital because the go, no-go decision is happening earlier in a company's development than ever before. And, you know, Jay, you talked about, well, you know, sometimes there's not money out there at the Series A level for companies that aren't really on all 4 cylinders or 8 cylinders, whatever the expression is. But I actually think that's a good thing because we're making better decisions about how capital gets deployed. So one other thing that I want to comment on, I think, Kathleen, you talked about convertible notes at the very early stage. It's an opportunity to kick the can down the road on the issue of valuation. We are seeing, interestingly, almost a 180-degree turn after 5 or 7 years of growing ubiquity of convertible note deals. We're seeing even the earliest stage investors wanting price equity. And there are a lot of reasons for that, and one is the tax benefit, potential tax benefit to both founders and investors from the qualified small business stock exclusion. You have to own a price equity, a common or preferred instrument.
And David, I would just add, in order to take advantage of the state investor tax credit, it has to have converted. It can't be at note stage, it has to be converted.
So same issue, right? You have this at the federal level, and Kathleen is saying we also have it at the state level. So there's a real incentive for investors, and frankly for founders, and we can talk about that at another point, to have a price equity round. Don't not go the LLC route and member interest, convertible notes, safes, kisses, where you know, there was growing ubiquity of those types of securities. So I think that's something you want to talk to your accountants about, you want to talk to your lawyers about that, and I think you're going to find that even early stage investors, many angels, are turning away from convertible notes and other kick the can down the road on valuation type transactions. Do we have time for some questions? Okay, so you know we're here. We're happy to take questions. We thank everybody. There is food and drink in the back. Stick around to network with folks that are here. And thank you. And I want to thank this panel, Gil, Jay.